Hi, I'm Joe Paul, and this is PwC's Tax Insights in Brief. On January 10th, Treasury and the IRS released proposed regulations regarding the base erosion and anti abuse tax and how qualified derivative payments, or QDPs, on securities lending transactions are determined and reported. A QDP is any payment made by a taxpayer to a foreign related party pursuant to a derivative where the taxpayer recognizes gain or loss on a mark to market basis and treats all gain or loss and other items of income or deduction with respect to a payment on the derivative as ordinary. Pursuant to the BEAT rules, QDPs are not treated as base erosion payments if they are properly reported to the IRS. For purposes of the QDP rule, only the securities leg of a securities lending transaction may be treated as a derivative. The cash collateral portion of a securities lending transaction is not treated as a QDP. The proposed regulations provide that mark to market gains and losses on the securities leg of a securities lending transaction would not be treated as a QDP and they would therefore not be included in the BEAT netting rule, nor required to be included in QDP reporting. Additionally, such mark to market gains or losses would not be taken into account when calculating the taxpayer's base erosion payments, even though they are not required to be included in QDP reporting. Substitute payments and other payments related to the securities lending transaction will still be reported. If not, it will be treated as a base erosion payment. The proposed regulations would defer the reporting requirement. Taxpayers would be required to correctly report the aggregate amount of QDPs on Form 8991 to satisfy the reporting requirements for the exception. Reporting the aggregate amount of QDPs in good faith would no longer satisfy the reporting requirements. The proposed regulations would apply to tax years beginning on or after the date the regulations are final. Additionally, specific rules for QDP reporting apply to tax years beginning on or after January 1st, 2027. The IRS is considering requiring taxpayers to report additional information on Form 8991 or another schedule and expects to provide a draft with the proposed changes for comments. Taxpayers should consider providing comments on the proposed regulations as well as comments on potential updates to Form 8991 or related schedules. Taxpayers should also monitor the Trump administration's approach to the proposed regulations. For more details, read the attached insight. Thanks for watching. This has been PwC's Tax Insights in Brief.